Hello, thanks for joining us. I'm Dan Coatsworth from Shares Magazine. I'm delighted today to be joined by Chris Mellor, product strategist at ETF provider Source ETF. Hi Chris. So ETFs are becoming popular in the UK. They're certainly very popular in the US. Do you think the UK is catching up and retail investors are really embracing this product class?
Yes, we're certainly seeing a lot more demand for ETFs in the UK and across broader Europe. As you say, it's a lag behind the US in terms of the size of products or the size of assets invested, but certainly there are signs that we're catching up. There's some very good reasons why investors in Europe are perhaps further behind in terms of uptake in ETFs than their US peers. First of all, ETFs were launched earlier in the US. They've been around for about 10 years longer. And secondly, I think there's more of a shareholder culture in the US. Individual investors are used to buying and selling shares on exchange, whereas in Europe and the UK, there tends to be more of a focus on funds and the use of funds to get investment exposure. With ETFs trading on exchange, like shares, but giving the exposure of funds, it's perhaps a more natural uptake in the US, but certainly there's been strong growth in the UK in recent years.
So people talk about ETFs being low-cost products, but there doesn't ever seem to be too much focus on the other parts of the ETF in terms of what's it's tracking and why it should actually be part of your portfolio. So what should a retail investor do when they're trying to research an ETF? Do they need to go as far as looking at an index and then going to see what's actually in that index that's being tracked?
I think it's a very good question. I think the first thing I would say is the key question you need to ask as an investor is, what exposure am I actually getting? Perhaps even taking a step back, what exposure do I actually want? Investing is built around taking views and then expressing those views. So if you believe that the US stock market is going to be stronger, how can I get exposure to the US stock market would be the first question. Obviously there's a wide range of products out there, whether it be individual stocks, whether it be mutual funds, or whether it be exchange traded funds. All of those give potential exposure. Something as simple as the S&P 500, well, simple to say, it's 500 stocks in an index. It's always worth taking a deeper look, looking at what exactly it is that the index is offering you. In the case of the S&P 500, as that example, it's large cap equity exposure, the 500 largest stocks, and then having a look down into what the actual stocks in that index are will give you an idea of what exposures you're getting. Obviously, for something like a simple market cap weighted index, it should do exactly what you'd expect. For some more interesting and differentiated strategies, having a look at the stocks that are in there will give you an idea of whether it is perhaps doing what you would expect it to.
Obviously with S&P 500 you could be able to find the constituents quite easily for that, but for some of the more complex indices that ETFs track, where do they all publish information? Is it just you can see this via searching on Google?
Yes, so any ETF provider should be providing that level of information. One of the great advantages of ETFs are that they're a very transparent and open platform. So all of that information should be out there. Certainly at Source, we have all that information on our website. So if you Google Source ETF, you'll find it very simply. And any index that we track, we have more than 70 products. The constituents of the index that we're tracking will either be on our website or available via the index provider's website, and also the actual investments that the ETF itself is making. They won't always be exactly identical to the index, even if the aim is to track that index.
So the rise of smart beta and factor-based ETFs, it's bringing an element of perhaps of rivalry to traditional actively managed funds. So if someone was to consider switching their portfolio to smart beta or factor-based ETFs, I presume there's enough back-tested data to show if those new products had been around for a long time, that they would still have done the job and being a proper rival to actively managed traditional funds.
Yes, indeed. If you look at the smart beta strategies, what are they doing? Ultimately, what they're doing is what actively managed funds have been doing for many, many years, but rather than doing it on a discretionary basis with a sort of human overlay making the final decision, instead what they're doing is doing it in a systematic way, building an index approach that follows a set of rules that then allows you to get that exposure that you're looking for. Obviously, the advantage of that index type approach is that you can look at what would have happened in the past if you'd been doing this. It's also worth saying that smart beta, a lot of the strategies aren't actually that new. If you look at something like MSCI Value, it's perhaps one of the simplest smart beta strategies. That's been around for more than a decade at least, and you have a full time period of live data with the index running in real time. And a lot of products out there have been tracking that index, So the data is there. As ever with back tests, you always have to be a little bit careful, as there's always a risk of selective data mining, if you like, that you find that something that worked in the past that may not work in the future. But if there's a sensible fundamental rationale for why that strategy should work, and there's enough history of seeing it work, I would certainly say that there's enough evidence to stack up and say that smart beta funds stand up very well against actively managed funds. And indeed, in the data that we have of live performance data, many of our smart beta funds do significantly better than the average active fund manager.
So smart beta and factor-based ETFs, I presume these are considerably cheaper than actively managed funds. Is there an obvious comparison between the two, and give an idea of what the gap is between the charges?
Yeah, it's interesting. If you look at the data, it varies from provider to provider, but looking at our product range, we have smart beta products that go from 0.2% management fee or ongoing charge up to 0.65% ongoing charge. So as you say, it's significantly below the sort of standard range for actively managed funds, slightly above the very cheapest market cap weighted index funds. We offer S&P 500 for 5 basis points, for example, as an ongoing charge. So it fits in that gap between sort of the very simplest passive and the more expensive active. As very much it fits in that gap between the approach of active and the very simple market cap weighted passive.
Thanks, Chris, and thanks for watching.
Thank you.